So, Steve, what's the big change for NAB out of this sell down?
It's not a big change as much as a kind of a positive signal. They've sold a chunk of their non-performing loan portfolio in the UK to a private equity player in the States. They will get $1 billion of cash in, about $230 million of equity will come out. But I suppose what it says about that portfolio is A, it was well provisioned because they actually will get some capital release, and their coverage, the general provision coverage, goes from 50% to 60%. So that kind of provides reassurance that NAB actually has been quite conservative in the way it set up this portfolio of distressed property loans in the UK, which they took onto the parent balance sheet back in 2012 to leave the UK banking businesses kind of as standalone, cleaner operations. So I suppose that's a positive. The fact that it's happening in the final days of Cameron Klein's tenure, I think that's kind of interesting. Andrew Thorburn will start with a smaller problem in the UK. That CRE portfolio, as they call it, commercial real estate portfolio, has still got $4.3 billion worth of troubled loans in it. But this was the worst part of that portfolio. By the look of it, they were all grossly impaired loans. So that's a positive. I think the other dimension to this, of course, is, and you can't get away from it when you talk about the NAB, and we haven't been able to get away from it for a decade, particularly the last half of the last 5 years, is the UK banking businesses. So they've got these businesses in Yorkshire and Scotland, which shareholders hate because they're not big enough to make a difference to NAB in a positive sense, but they've been a source of trouble since the financial crisis. So the market would like to see NAB exit. This, I suppose, says that the property market in the UK has improved. We saw recently that Lloyd's floated off its TSB unit, and it was very well received by the market. So the environment for selling UK banks has improved. And so I suppose everyone will be looking at Andrew Thorburn when he takes over formally on 1 August and saying, how long will it take him to get out? Because Cameron Klein wanted to and couldn't. The environment didn't allow him to. Thorburn takes over a time when the UK economy and the property markets are better than they were.
So it's a good time to actually stay in the UK, you would think, given that it's now growing and growing much faster than a lot of other economies in the rest of the developed world.
Well, you and I might think that, and I've always thought that there was an option that you could either get out or get bigger. Remembering that NAB for decades tried to get bigger, talked to everybody in southern UK and in England, trying to find a way to grow in the south and the more prosperous parts of the UK, and failed at every attempt, which is what led us to this commercial loan portfolio, because having failed to buy something, they decided to go for organic growth, and they decided to target investment property lending, which turned out to be not a very good decision. But I think Thorburn intellectually would say, I have that option, but he also knows his shareholders probably won't allow him to exercise the one that says, I'm going to grow by acquisition, even though the environment, as you say, has improved, and the potential to buy assets in the UK has improved because, of course, all the UK government bailed out banks are flogging off bits of their businesses as they've been directed to, both by the Europeans and by the UK government.
And they've been cleaned up in the process.
So the environment for growing by acquisition actually has improved, but the tolerance for NAB's growth by acquisition in the UK probably just isn't there.
Now, those shareholders don't want them to expand the UK, obviously, but they do want to get some dividends, I'm sure. So looking at that commercial real estate portfolio they're going to sell off, does that mean there's going to be some money freed up for NAB, for investment or for shareholders?
Out of this sale, about $230 million of capital gets released. So it's not meaningful in the context of NAB, but it says that there's potential for further capital releases going forward now that we know that portfolio actually does stand up under scrutiny. If they were to sell out of the UK entirely, we're talking $4 or $5 billion maybe, that would be much more meaningful. And so the potential for some sort of capital return would be there. I think more broadly, if they were to exit the UK, their return on equity would actually be very strong. It's often not recognised that, excluding the UK, NAB actually is a very well-performed bank with a return on equity that's comparable with any of the other majors. The Australian business is a very well-run business. Clients done a really good job on the domestic businesses and New Zealand. The UK has been like an anchor on their performance. It shaves a couple hundred basis points off their return on equity. So if they could just exit that without taking a hit, without taking too big a hit, all of a sudden they'd look like a very well-performing bank. And I think that's why the market keeps saying, please, just get rid of these things.
How big is that discount at the moment for NAB versus its peers?
Their ROE is probably somewhere, depending on which the peers you're looking at, somewhere between 100 basis points and 300 basis points lower than their peers, even though the Australian businesses are right up there with any of the other banks.
Stephen Bartholomeusz, thanks very much.
Thanks, Jackson.